Hello and welcome to Switzer Investing. I'm Peter Switzer, and we're doing this on the Gold Coast today because I've got a speech that they've been trying to organise this speech for over a year, and it's a good sign for the economy when events are going ahead. In fact, when I went into the Gold Coast airport from Sydney, there was no police checking whether you were vaccinated or not. That's another positive sign, I think, for the economy, that kind of the barriers and obstacles to economic growth are gradually dissipating and disappearing. But the stock market's not seeing that way. At the moment, the stock market is very, very negative. I personally think it's a buying opportunity, but of course you have to work out when the right time to buy comes along. And to try and work that out, I've got my good friend and expert on the market, Rudi Filapek-Vandyck of FN Arena. We're going to look about and we'll analyse just how scared you should be about the current sell-off. He also looks at 5 or 6 stocks that have been upgraded by the analysts. So they believe that A, the company's doing well, and B, there's plenty of upside to their share price. So I'll share them with you when I show you the interview with Rudi Filapek-Vandyck. Then I've got Bogdan of Blackmore Capital, who manages the Switzer Dividend Growth Fund. So of course, he's a dividend specialising fund, but he does chase growth as well. And Marcus quite likes companies like BHP and the telecoms. He thinks telecoms are looking very good value, particularly when it comes to the yield. And that's because the share price recently has fallen pretty steeply. He looks at those 2 sectors, resources and telecoms, but he also looks at some others as well. And finally, because this is the Thursday show, I always like to include a bit of property. We've got Simon Pressley of Propertyology. Simon's a really good analyst when it comes to investing in property. And he gives us his 7 tips for property investing, and they are really, really informative. I like the way he actually looks at property from a stock point of view. Some of the values, some of the drivers that help me pick stocks, he actually uses the same kind of drivers to pick property as well. That's the show, so let's kick off with Rudi Filapek-Vandyck of FN Arena. Well, our first guest on the program is Rudi Filapek-Vandyck, the founder of FN Arena, and a really appropriate day with the market behaving kind of strangely, up a lot early, then down pretty solidly. I'm very interested to hear what Rudi thinks is going on. Rudi, thanks for joining us.
Oh, Peter, my pleasure. It's the first time in 2022, and there has to be a first time at some point.
Yeah, exactly right. Exactly right. And we're honoured that you've made the time for us.
Yeah.
Rudi, we all were waiting to hear what Jerome Powell had to say. And it seemed like the market liked what he said. I think the Dow went up, didn't it? Did it finish up?
Oh,
It might have gone down in the end. Maybe it went up for a while. But then we had a nice solid start here. And I looked at my super fund and I was feeling very happy with myself. And I looked at it before I came to talk to you, and I'm not so happy with myself. What do you think's going on?
Peter, I think there's actually a whole lot going on. And you will remember that sometimes I compare the share market to a very volatile teenager. And that means that the share market can actually pay attention to one item at a time. And at the moment, there's quite a lot. And I wrote a story this week just to keep investors and a little bit informed. It's not just Powell and interest rates. I mean, I have to say this, for the very first time, and I've been doing this for quite a while, for the very first time, I actually was a little bit worried this month that we might actually get some military action around the world, and this time involving some of the greater powers of today's world on opposite sides. And I think at the very least that will unsettle some people, and it definitely made me a little bit wary as well of what could potentially unfold in terms of scenarios. It doesn't mean that we will obviously have that we're on the cusp of World War III here, but it can mean that we can get some nasty news either from Russia or even from the Chinese as well, and that's obviously something that we don't want to see that. and I can see how some people take that as a reason to take some risk off the table.
Yeah.
Now, if you leave that aside, because I mean we could really speculate what Putin's plans are and how that's going to evolve. I also think one of the, apart from from all the bond yield, interest rates, consideration, everything, I think what we're seeing in the Australian share market also is something that we haven't seen for really a long while, is that we're actually seeing profit warnings, and this every day there's a number of companies that fess up and say to investors, listen, we know those expectations from yesterday. Well, we're not going to meet them, basically. And you see share prices going down by 7, 13, 20%, depending on what type of company it is and how severe the profit warning is. But we have to go back to 2019, when was the last year that we had profit warnings that we actually paid attention to, because we obviously had them in 2020, but investors in 2020 were prepared to look through the short-term impact and ignore that. Then in 2021, we had no profit warnings. But there might have been a few, but there's none that comes to mind in my recollection. And now all of a sudden we're back in 2022. I meant to say 2021 before, by the way. And now we're back in 2022. And all of a sudden it looks like we're back in 2019. And in 2019, if people remember, 2019 was not a good year for the Australian corporate Australia. We had lots of profit warnings, both pre-February as pre-August. And then we got a lot of profit warnings after August, because then we had the energy companies, the cyclicals, and the banks cutting their dividends and issuing really dire warnings. Now, we're not back at that stage, but we're obviously coming back from a market that has been quite positive in 2021. Yeah. Share prices, I think everyone agrees on that. You're going to disagree on the level and the gradient, but I think everyone agrees that share prices weren't particularly cheap when we left 2021 behind us. And now, of course, we have a lot of uncertainty, and we're seeing profit warnings. So the initial response that we have is, of course, when share prices go down by 10, 15, 20%, is, oh, there's a lot of value on offer now, because it does make a big difference. But if those companies then issue profit warnings, then all of a sudden it becomes more of a muddy concept now, because they're not supposed to issue profit warnings before they sell off by 20%.
Yeah, Rudi, so is a part of it, do you think, well, some businesses are suffering a lack of business because of Omicron, less people showing up to their restaurants, their hotels, their airlines and whatever. And on the flip side, Omicron and its related Delta variant has been really bad for supply chain, pushing up costs. So you've got a shrinking demand, higher costs, and so that probably is at the core of a lot of these concerns about profits.
Absolutely, and you can combine inflation as well. We tend to discuss inflation in terms of it has an impact on the RBA and on bond yields. But for a lot of companies, it means the input costs are going up, and they can't quickly remedy that. So that means less profits. And we've seen that over the past few weeks, that a lot of resources producers have to come out and say, like, listen, we are still digging enough out of the ground, but we're doing it at a higher cost, which means we won't make the profits that you thought we were making.
Yeah. So I'm going to eventually say to you, we'll look really at lots of stocks have been sold off, and a lot of the selling seems to be indiscriminate, as it often is when markets get really afraid. So I'm going to ask you that before I release you to the real world again, rather than the Switzer world. But can I ask you this question? Do you agree with this? And I often use you as a sounding board for some of my more controversial views on what might happen. So we started the year off, and I think that the Fed was kind of looking at 3 interest rate rises. And the bond market basically said, no, we think it's more like 5, right? And then Jamie Dimon, the CEO of JP Morgan, said 7. and a guy who I actually do respect, and I've made a lot of money believing in what he's said about the US stock market, namely Professor Jeremy Siegel. He thinks there could be 8 interest rate rises. I think he's going to be wrong on that. I think Jamie Dimon could be wrong on that as well. If we end up getting less interest rate rises, then the worst case scenarios are factoring in. Do you think that will be a trigger for a comeback in stocks and even some tech stocks that have been excessively sold off on the basis that interest rates could go a lot higher than we thought at the beginning of the year?
The short answer is yes, yes, and yes.
That's it. Okay, we're finished now. That's all I wanted to hear.
about the technology stocks, I think it's more important for people to understand that not all technology stocks are equal. Yep. And there's a gigantic difference in quality, and I agree. I've already seen some other people making those calls. I wholeheartedly agree. I would probably own a few of those companies myself. That the quality will rise to the surface, and even though in the short term it's indiscriminate, they will recover quicker and they will return much higher benefits in the long run. Some of those lower quality technology stocks, they will never return to where they were, and that is simply because they didn't deserve to be there in the first place. Yeah. I think to answer your question into more detail, I think it's not just, although I sympathize with your sentiment that, and that's probably true, that the market is getting again ahead of itself in terms of bond yields, interest rate hikes, etc. But I think the question mark that remains is once this tightening starts, is how it's going to impact on the economy. And I've seen quite some analysts, some market strategists making a call for this year that we will have a recession scare, which doesn't mean we're going to have a recession, but we're going to have a recession scare. Yeah. And that in itself is further reason to spook investors and to keep volatility high and potentially more selling. But I also agree with your underlying sentiment. Ultimately, we will get out of this, and I think those investors who have the quality stocks in their portfolio will do better throughout the volatility and over time.
Yeah, and it's like the classic example to me, and this is take the tech stocks, and I think tech stocks will take time to get re-loved again. But in Australia, I would rather Xero over Nuix.
That's an easy one. That's an easy one.
But Nuix was $11 stock, and they all thought it was a fantastic company. And all of a sudden, we realised that they weren't as believable as we thought they were.
But I think in that case, Macquarie sold us a pig with lipstick on.
Yeah, very true, Rudy. Okay, so before I get you to name some stocks you think really like good value, so therefore, for the long-term investor then, because this is a time for short-term traders, isn't it? They've made money, they're quick sellers, and they'll probably be buyers of the stuff they're selling today in a couple of days' time or a couple of weeks' time, whenever the sentiment turns around. But there's still a great opportunity for the long-term patient investor, but they just have to have A, the courage to buy, and B, just wait until what I think will be strong economic growth somewhere down the track 2022, which rolls into 2023, and maybe question marks will be along 2023, too many interest rate rises and all that sort of stuff. But we'll talk about that in 2023, God willing. All right, so do you think this is a buying opportunity for the patient long-term investor?
Yes, but of course in selected stocks, and I do think that there's two types of risk. One is that you buy today and share prices fall for the next week, so you basically meet your timing is off. Yeah. That does by no means mean that your stock will not perform. I mean, it just means that you didn't pick the bottom. Yeah. The problem, the other risk is that if you try to pick the bottom, that you actually might wake up on a day and the market is up by 5%, which is very, very likely when the selling is so persistent. And then, of course, then you have to buy it in a higher level. So it's not an easy. But what I notice, and as you know, and hopefully the viewers know this as well, is that I do pay attention to all the views that come from the experts and from the subbooks and stuff like that. Here's one thing I started to notice. They started to issuing upgrades for the quality stocks in the market. And you mentioned Zero earlier. I haven't seen anything for Zero, but I have seen the upgrades coming in for Pro Medicus, for example.
Yeah.
And today RBC Capital put from memory a $58 price target on Pro Medicus, saying you have to take a 12-month view, which basically says, can the share price go weaker tomorrow? Absolutely. And next week and next month. Yeah? But they are quite comfortable that a quality stock like Pro Medicus, if you take a year or 2 years view, at today's price already, which I think is around in the early 40s now, would be a great buy. And I'm almost inclined to agree with that. I mean, I still own Pro Medicus. It is a relatively small size in my portfolio because that's my way of reducing risk. I just reduce my exposure a little bit, but I don't really sell out completely. But there are a few other ones. I mean, REA Group and Seek have received upgrades. One that hasn't received the upgrades, but which I would nominate almost by default, would be a company like MCOR, which I, apart from indiscriminate selling, have no idea why they're selling in the first place. And it should be a lot higher than where it is today. But I've also seen, for example, upgrades coming through or positive commentary coming through for companies like a Breville Group. And I own that one too, by the way. And I'm a big fan still. And I've seen positive commentary coming through for ResMed. And ResMed, of course, reports on Friday, which is tomorrow. And in the short term, again, because we're in this context of supply chains, problems, and maybe chip shortages, so it is well possible that a company like ResMed in the short term can't meet market expectations because it's outside of their hand. But analysts are pretty much convinced that they will have a good year ahead of them, which means post this quarter, which they are about to report, it should be okay.
Yeah, so both Breville and ResMed have had upgrades, are you saying?
Yes, they've both been upgraded, yes.
Okay.
Yes.
Now, here's a really easy one, Rudi. In our long relationship, whenever I say to you, what's the quality company you would recommend, you always come up, like Paul Rickard does with CSL.
Yes.
Yeah. As current price, when we did our Boondoon Zoom show this morning, Paul made the point, with its capital raise coming on, the price could be 244.
It's probably looking towards a shortfall.
Yeah.
Because I think the logical response from a lot of retail investors is, at this price, I'm not taking up my share. They're still getting a 2%. Like a lot of people don't pay attention to detail, but so they should know that CSL has guaranteed them that they will get an advantageous price. So if the price falls, you get 2% off an average over, I think, 7 days leading into the 7th of February. So at this price, you're gonna get it somewhere in the 240s. Yes, you're gonna get a really big deal. The institutions last year paid $40 more per share. So I would take it up, to be honest. I mean, I remain a believer in that long-term story. And as a matter of fact, I mean, 2023 should be sort of like a recovery year for CSL in the first place. Okay. At the moment, of course, the market is focusing on the fact that they will most likely have a funding shortfall, and that's bad news.
Yeah, I still think they'll find the money somewhere.
Oh yeah.
Of course. It could affect their short-term profitability. One last question to you, Rudi. What is the company that all those companies that the Courageous bought in May and June of 2020, namely the Webjets, the Qantases, all those sort of travel stocks, and we're hoping that reopening would come by November of 2020, and didn't happen, and then we hoped it would come by the middle of 2021, and it didn't happen. But to me, it looks like unless another curveball Omicron comes along, it looks like a very good chance that we will be traveling OS in 2022. If that happens, and we know these stocks have delivered really well for the courageous investors in the if you bought in those early months after the crash. People who bought a bit later may well not be as happy. Is there another leg up for these? Like once a company like Qantas is back normal, and even Rudi Filapek-Vandyck and his beloved goes to Belgium for the first time in a long, long time.
Peter, it is definitely possible, and obviously you've already sort of like answered your own question, but I have to point out that the market has consistently been too optimistic about the reopening of those industries, and just some industries, like for example movie theaters, I'm very cautious. I mean, I can almost not see how these guys can survive without extra injections, help, support, you name it. And I'm not so certain how quickly the travel is going to recover, including business travel. And also there's other changes as well. Work from home will stay around. Offices won't disappear, but it will still be not as the old regime. And we are going through changes. I mean, we will do more online, etc., and some things will never go back.
Yeah. So on that basis, one final question then. I know you don't. Well, I always presume you don't invest overseas, but you're such a wily investor. Maybe you do. A company like Zoom's been smashed up, but Zoom is going to be replacing a lot of business travel. You and I are doing this on Zoom. I get access to CEOs like I never get access before. The quality of my program is better as a consequence of Zoom. Is this going to be a company of the future, do you think?
It's an interesting one, because I know from experience and from what I hear, and I use Zoom, I know that a lot of people like you and me, we like Zoom. But I also know that Zoom is far from the only one in that sector. And for example, in the business world, people tend to use, I think, the Oracle alternative and the Microsoft alternative, Microsoft Teams. Yeah. So I think it's not that straightforward. There's more to it, and I do believe that Wall Street at some stage got worried that Microsoft does what it did with its browser, and that's basically destroying all the other ones, or trying to. So there could be some competitive pressure there. So I don't analyze Zoom very closely, but I do know that the share price has come under pressure a lot. Yeah. And I do think that the advent of Microsoft is because Microsoft, let's face it, you better not find yourself on the wrong side in the market if Microsoft is on the other side.
It's the gorilla that keeps on delivering for shareholders.
It's amazing. It's truly one of those companies that just keeps doing it, basically. And shareholders, I mean, I can't imagine there's one unhappy shareholder at Microsoft.
That's for sure. Mate, thanks for joining us on the program. As always, great to see the founder of FN Arena, Rudi Filapek-Vandyck.
Thank you, Peter.
Well, catching up now with Marcus Bogdan, the fund manager from Blackmore's Capital, and he looks after the Switzer Dividend Growth Fund, which specialises, of course, in dividends, but Marcus is always on the lookout for growth as well. And at the moment, there hasn't been much growth. The market's been down pretty seriously since the beginning of the year.
It has. It's been a very unusual start to the year. The ASX 200 is down around 6.5%. So it's a significant pullback, but the underlying movements are quite interesting, and there's definitely been a separation or a bifurcation in performance of the markets. What has done incredibly well is the big Australian, BHP, has actually moved up considerably in the last month or so. You've had the unification shareholding agreement there, and also quite strong underlying commodity prices, particularly iron ore. That's going to generate a lot of cash for BHP, and that will represent a very good dividend yield expected for their first half result. Energy has been well supported because of the oil sector, but on the other side of that, growth stocks are the ones that have been punished considerably, with the expectation that interest rates now will start to rise and potentially quite aggressively in the US. I don't think we're going to have that same framework in Australia or to that extent. And the other areas which have been affected, and they've been affected because they've been in the jaws of Omicron, has been the healthcare sector and consumer staples. And I think both of those sectors are starting to look interesting because I think the impacts that they're seeing will be short term.
Yeah, it's interesting today. I did a story for 2GB around the fact that food prices in the December quarter, the inflation basically doubled. Not food price, but the rise in. And that should be good for some of your holdings like Woolworths and Coles.
Yes, it should. That should certainly translate. And you're starting to see inflation not only in fresh, particularly in meat, but also now in dry goods. And historically, that has translated into a better performance for the supermarkets. And both, obviously, Woolworths and Coles are in the portfolio.
Yeah. You make reference to telcos. Are you saying that the dividend yield looks good because the market has probably oversold these companies?
Well, they have also come back in the last month or so around of where the market has pulled back around 6%. But Spark New Zealand, which is the New Zealand telecom company, which is listed on the ASX 200, is now providing a dividend yield of around 5.7%. We think that is absolutely maintainable, and they should be able to grow their dividend over the forecast period. And Telstra, which was one of the outperformers last year, has also come back in January, and now they're yielding just over 4%. The 16 cents we believe is maintainable, and Telstra has the additional benefit of franking credits on top of that. Okay,
so I noticed that the unit price of Switzer Dividend Growth Fund has copped it. And I figure part of it's because the banks have copped it and so on and so forth. Are you expecting a rebound of the unit price as the banks and some of the core holdings of your fund start to recover from the sell-off?
Yeah, they are absolutely sensitive to those elements. Importantly, the reduction in the portfolio hasn't been as great as the market over January so far, and it's exhibited lower volatility, better downside protection. But you're absolutely right. Collectively, the banks, consumer staples, healthcare sectors, I think those all should recover over time. And the banks are interesting because they should pay attractive dividend yields of at least 4%, and they may be beneficiaries of higher interest rates and improving their margin outlook.
Okay. What is your position on the Westpac buyback?
The Westpac buyback, depending on tax consideration, but obviously that franking credit that potentially that you can receive is attractive for those investors in the right tax bracket.
But it's not necessarily something you participate in with the fund.
No, and I think, but it will result. The net result of it will be that there'll be fewer shares on issue for Westpac, and that will be beneficial to earnings per share growth and the sustainability of the dividend.
And what about CSL? What's your position on CSL?
We still believe that CSL is one of Australia's outstanding companies, and that the outlook for CSL remains particularly promising. In its underlying business of plasma therapies, the level of new R&D expenditure that they've got there, and the potential of new products, and they've got a very strong history of bringing new products in and new revenue streams in. The vaccine business should continue to do well, but they're currently acquiring a Swiss company, and that is expected to deliver be EPS accretive over the forecast period. And so CSL has been sold down. It's been sold down over 10% in January, but we believe that the underlying fundamentals of CSL remain robust.
So if you were forced to make a decision about whether CSL was a buy at these levels or a sell, what would you say?
Oh, for the investor, for the medium to long term, we certainly believe that CSL remains a core portfolio stock.
Okay, let's get big picture now. We know that part of the negativity around at the moment is that the US is going to be raising interest rates, and basically the central bank boss there, Jerome Powell, said this morning it's going to be March. What is your best guess on how many interest rate rises the Fed will impose? You know, we once were talking 3. I think the market has been predicting 5, but you've got Jamie Dimon saying 7. I think Jeremy Siegel has actually said 8. What's your best guess?
Well, as someone like you who studied economics, it is a social science, and six months ago there was no prospects of interest rate rises in the United States in 2022. Fast forward, with much higher inflation, very, very strong employment numbers, and the Federal Reserve is deeply behind the curve, and so that has accelerated their push to not only cease their liquidity, but also start to raise interest rates. And I was on a conference yesterday with Goldman Sachs, and their suggestion is that there'll be 4 interest rate rises in the United States. But I think it's a quite different prospect for Australia for this year.
Yeah. Well, let's finish on Australia, but let me just do one last thing. That given the fact that the market is a little bit more excitable about rising interest rates than, say, Goldman Sachs and even the Federal Reserve, do you think then that if it does come to pass that rates don't rise as quickly as some people think now, tech stocks could actually come back into favour because A, they've been sold off, and B, the interest rate scenario might not be as scary as it currently is?
If bond yields start to fall on the expectation we've got slower economic growth, or the pathway forward on those interest rate rises is not as significant as you're stating, there will be a recalibration and a re-look back at those growth stocks. But I think the emphasis on those growth stocks has to be first and foremost on those growth stocks that have actually got profitability. You know, those companies, those strong companies such as Microsoft, rather than those companies which have good growth prospects but are still not translating that into earnings. Yeah. So I do think that this year the emphasis will be on quality and sustainable franchises.
Okay, let's finish up on local interest rates. Until the inflation number this week, we were thinking November was more likely. Now we have Bill Evans from Westpac go for August, and a lot more economists are agreeing with Bill now that August could be the first rate rise, and then they might have another 2 after that, and we could end up at 1% by the end of the year. What's your feeling on that?
Well, we're certainly not going to be moving at the trajectory of the United States, and nor should we, because our economic fundamentals, whilst they have similar characteristics, are different. But in the latter half, if we continue on what we expect to be still good economic growth in Australia, a very good outlook on employment, and also starting to see wages growth coming up to where the RBA would want it to be, I think it is a natural extension that we do start to see interest rate rises coming off their very, very low base. And I don't necessarily think that that's a bad thing. I think if they can do it gradually and consistently, then I think the markets can absorb that.
Yeah, great stuff. Marcus, Bogdan, Blackmore Capital and Switzer Dividend Growth Fund, thanks for joining us.
Thanks, Peter.
Well, joining me now is Simon Pressley from Propertyology. Good to see you, mate.
Hi, Peter. Happy 2022, my friend.
Yeah, thanks very much. And I guess if you're a permanent property bull, which I'm not, I know property doesn't always do fantastically well, or at the same time, right across the country in every city or province. But certainly, we know interest rates are on the rise. It's been a fantastic time for lots of investors out there in property or owners of property. But this year could be a little bit more challenging. What do you think, Simon?
No, I think 2022 is going to be, it'll go down in history as one of the best years for property markets. Unrealistic to expect that it will be as strong as 2021, but geez, it was an incredibly high bar that we set last year, wasn't it? But large parts of Australia this year, with or without interest rate rises, will get double-digit growth, I think, this year. Some locations will be really, really deep into the double digits. Will probably exceed 20%.
Yeah, and even if interest rates rise, as I expect that they will, they're still coming off such low levels.
Yeah.
And so let's go through. I asked you to give us sort of your 7 great tips when it comes to investing in property. And your first one is around the financial instrument. What's that all about?
Yeah, so I mean, whilst property and shares are completely different asset classes, when you're looking to acquire property for investment purposes, you need to adopt a very similar mindset to what a share investor would do. Propertyology sees property not about the bricks and mortar. It is a financial instrument. So we're not making decisions based on how the bricks and mortar looks or whether ourselves would live in it as a family home, because that's not the objective. It's a financial outcome. Whether a location's coastal or inland, or whether it's got a warm climate or a cool climate, are personal and highly subjective things and nothing at all to do with how a market will perform.
Yeah, I must admit, Simon, when it comes to investing in stocks, I always like to buy quality companies when the market really wants to sell off. Can the same opportunity happen with property, do you think?
Well, the different thing about property to shares is it's highly subjective. So what constitutes quality? You know, for some people, it will be Sydney, you know, but for some others, it's Byron Bay. For someone else, it's Orange in New South Wales or Ballarat in Victoria. So it's a subjective definition that I would discourage any property investor trying to create their own definition for, and understand what the F word means. What does fundamentals mean for property markets, and where do we get that information and interpret it?
Okay, let's get your second one now. That's growth drivers.
Yeah, a lot of people, for growth drivers, they think it's to do with population growth. Well, we've produced all sorts of evidence-based studies over the years proving that whilst it is an influence, it has a very nominal influence in the overall scheme of things. Growth drivers for property markets is all about economic growth. And to do that well as a property investor, we need to pay less attention to the macro factors such as Australia's economy as a whole or Queensland's economy as a state. And we need to take a keen interest in the micro economies, the individual towns and cities, the decisions that are happening today and how it's going to affect their local economy. If you get that anticipation correct, that's where the property growth will come from that economic growth.
Yeah. What's the best example of a place that had its own individual, overwhelmingly great economic growth, and as a consequence, property investors did very well?
The one that comes to mind immediately in recent history is Hobart. If we go back to 2013, property markets had just started to accelerate in places like Sydney and Melbourne, but they were dead flat everywhere else. And the state of Tasmania was in recession in the year 2013. Nowhere else in Australia was, but Tassie was. We invested in Hobart in 2014 on the anticipation that there was going to be significant and sustainable economic growth. Fast forward the last 7 years, there is no property market anywhere in Australia, capital city or region, that has performed better than the city of Hobart, and that's an economic growth story.
Yeah. Let's get a third one now, 100% of your options.
Yeah, so a share investor would recognise there are thousands of companies on the stock exchange. The equivalent of that to a property investor, we've got the obvious 8 capital cities, but there are also 200 individual regional towns and cities. Some of those locations are very big. Geelong and Wollongong and Sunshine Coast and Gold Coast, for example. There's some medium-sized ones and some really small ones. But we need to consider all of our options to give ourselves the best chance of making the best decision for financial gain. And we need to see ourselves as what we call borderless. Where Peter chooses to live and Simon chooses to live is completely irrelevant when making that investment decision. All of Australia is the equivalent of the companies on the stock exchange to us.
Yeah, it's interesting. I'm thinking about this now as I listen to you. I know one of my guests on the program, Julia Lee, the fund investor, she said that you often find on the Australian stock market that the stocks that did really, really well last year have the momentum to do well again in the second year. Do you see the same kind of thing happening when it comes to those sorts of areas that have started to do well that last more than a year?
Yeah, so in property markets, we call that a growth cycle, usually referred to as a period of years where well above average rates of growth are seen. But there's no mathematical formula for this, and the growth cycle is determined by the decisions we've been talking about there earlier, economic growth and understanding the supply channels of things. But it's very rare, Peter, for an individual town or city to have a growth cycle that goes beyond 4 years. History has taught us that. So a market that might be doing well today, but it's already done very well for 3 or 4 years, logic suggests it's probably closer to the end of its cycle than the beginning of its cycle.
Has Byron Bay defied that generality?
It has, and that's why it's important not to generalise. That 4 years is historically proven to be as long as you get, but we still need to look at the individual fundamentals and make an objective assessment. And if the fundamentals are still strong, then that growth cycle will continue. Hobart's that story. Fundamentals today are as strong as what they've ever been, but yet it's been in a growth cycle for 7 years already.
Let's go to your fourth one. Respect the #1 golden financial rule.
We've all heard of it, but unfortunately, most property investors are horrible at paying attention to it. Do not place all your eggs in the one basket. Whether it's a business owner who doesn't want to have too much of their annual revenue coming from one customer, or whether it's a share investor having too much exposure to one industry on the stock exchange, property investors, for the same reasons, need to respect the golden financial rule. So for Propertyology, we refuse to buy a property that costs more than $1 million. We have clients who can afford to do that, but you should never put so much capital into one asset. We don't want to have too much exposure in any one city or any one state. So again, we're following principles that the share investor would do as they're building a sustainable portfolio on the stock market. We're doing a similar thing for a property investor on the property market.
Yeah, it's diversification, isn't it, mate?
It is.
Let's go to your fifth one now. Respect cash flow.
Yes, cash flow is very important for property investors because this asset class is very expensive to acquire. It's almost always associated with a debt attached to the asset. So there's absolutely no excuse in a climate like now where we've got interest rates that are roughly 2.5%. And even if we sort of said, look, at some stage over the next couple of years, they might progressively go up to 3.5%. That's still an incredibly low interest rate. Large parts of Australia, you can still get a really strong rental yield of somewhere between 4% and in some cases up to 5.5%. So there's no excuse for any property investor to be buying an investment property and to be forking out more than $5,000 or more per annum to supplement the shortfall between annual rents and annual expenses. No excuse.
Okay. Don't touch apartments.
Don't touch apartments. Yes. Again, we're very evidence-based, and we're not saying that apartments will not grow in value or that townhouses will not grow in value. But what the evidence has totally taught us is that a conventional stock standard detached house will always have the widest volume of future buyers. So we'd be crazy to not pay respect to that really important piece of evidence: buy detached houses.
Okay, your final one, genuine experts.
Yeah, so I guess property is one of those things. We all live in a property, whether we own it or whether we rent it. But it's important as a property investor that we're always aware that everyone's always going to have opinions, and don't confuse the stuff that you can read as quality research. be wary of, albeit well-meaning, but comments from banks and a lot of property commentators and general media, unless they are actually studying property markets for a living and earning their own income from, a good reputation. Well, they're not experts at all. They're just expressing an opinion.
Okay, mate. So given all that, what has been your best investment and why?
I mentioned it earlier. Hobart was one of several. And that comes about by having the courage to ignore what everyone's saying and objectively analyse the market fundamentals. In different years, that's places like Orange. Orange has grown in central New South Wales. Median house prices basically doubled in the last 6 years. If you went back 6 years ago and did a straw poll of every so-called expert in Australia, which property market will be the best performer, no one would have said Orange. And these locations, the best performers, if you broke Australian real estate down to blocks of 5 years, they're more often not going to be among the 200 non-capital city locations than the 8 capital city locations. So maybe that's my tip number 8, Peter.
Yeah. Early in the 2000s, when I was doing talking business for Qantas, I interviewed a guy who was pretty sharp when it came to property. And he said he was going up to a place called Beenleigh, which I didn't know all that well, but it's around the Sanctuary Cove area, isn't it? A bit north of that. And he was taking $1 million and he was buying 10 properties, average price around $100,000. And he looked at me and he said, and they will all be property positively geared. And he said, and he didn't know what they were going to do, but in the space of 2 or 3 years, the prices there nearly doubled. And I thought, when you can buy assets where you start off, every one of them is positively geared, that the money coming in is more than the money going out to actually bankroll it, and you get that kind of capital growth. That's really good property investing, isn't it?
A great story. Not what we would do though. He's respected the cash flow, but he's put all these eggs in that one basket. So, no one has a crystal ball, including propertyology. And if your analysis, gets it wrong, or something changes that no amount of research, could have brought to your attention before you make that decision, then you've exposed all of your capital to that. So, needs to spread it. Great for him, but not what I would do.
Yeah, and I should say he's the kind of guy who had lots of individual millions around lots of different areas.
There you go. So he has spread it around.
Yeah. He was a professional. Great to talk to you, mate. That's
always a pleasure.
Pressley of Propertyology.
Thanks, Peter.
And that's a show for this week, filmed on the Gold Coast via Zoom, of course. And thanks for joining us. Remember, a lot of the stuff we talk about here is looked at in more detail in the Switzer report. And so I think you should go to switzerreport.com.au, the website, get a handle on what we're offering with the report. It does give you insights that will help you invest successfully and in a rewarding kind of way going forward. So have a look at switzerreport.com.au. Once again, thanks for joining us. I'll talk to you on Monday night.